Hello, welcome back to the continuing lecture in investment analysis. This is Dr. Jeff Hong, and this is like video number 21. So in our last video, we already discussed the example of finding, ROE, earnings per share, and expected growth rate. I mean, given earnings per share and ROE, return on equity, and either given the dividend payout ratio or directly a plowback ratio, we have we did a little exercise on forecasting price and price earnings ratio. Now, I also briefly talked about, the possible scenarios when these variables, especially the growth rate and K, right? When these variables change. So, first of all, it is understandable. It's quite understandable when required return goes up, right? The whole P ratio would go down because it's just the nature of the fraction, right? Because when we are assuming that if we are assuming that the required return goes up while growth rate is a constant, right? What's going to happen to the denominator? In this formula, as K goes up, cost of capital goes up, the whole denominator will go up. And as the whole denominator goes up, right, the fraction would go down, right? And, because it is just straightforward mathematical fact, right? While when numerator is held, steady, and denominator goes up, the whole fraction will have to go down. But then, why would cost of capital go up or required return go up? Why would that go up? Usually, the required return would go up if the project considered more risky. So, ceteris paribus, this is all other things being equal. I mean, if you're a student of economics, this is something you have heard over and over, ceteris paribus, right? Other things being equal. Riskier stock, lower PE, lower P multiples, in other words, a price earnings ratio, since higher required return that means riskier stocks would require higher required return. So cost of capital goes up, and we're assuming growth is constant. If both goes up together, think about it. That was what I was talking about in a couple of previous videos. I mean, a couple of videos ago. Yes, definitely. I don't know if there's more space. Yeah, definitely. Think about it. If both K goes up and G goes up, right? If they both go up, what's going to happen to K minus G? Oh, what's going to happen to K minus G depends on which effect prevails. In other words, if change in K is greater than change in G, then you will still have the whole, K minus G will be positive, right? And second scenario is, of course, if change in K change in K is change in G, then there will be no change. It's not zero. It's not going to be zero. It's change. So there is no change in, what I should say is, yeah, change in K minus G is positive, and change in K minus, in this case, change in K minus G is zero. And third scenario is this, but third scenario is not something to be, we should be concerned. Which one happened in reality, right? Of course, that is the case when change in G is greater. Of course, then in this case, it's going to be negative, right? But this is not likely to happen. Why? Because if it is, for change in growth rate greater than change in K, the cost of capital, no investor would demand less required return than the growth rate. Okay, if change in G is so great, right? If this is so much, right? That means it's a very risky stock. Yeah, risk means, it's like Tesla. You think Tesla is a safe stock? No. It's been doing very, very well, but risk runs both ways. If there's a wide, in other words, it's a wide variance, right? When if you go back and look at Apple's data, I've been tracking Apple almost a decade, and not that I have Apple stock. I had Apple shares, back in 2014, but I sold them, and after that, I don't own Apple. I own basically, entire I own the entire market through ETF. Um, but anyway, Apple had, in during the good years of Apple, right? When they had like, almost, 20, 30% monthly return. They also had during the same year, almost, matching. It's not it's not perfectly symmetrical, but negative, 18%, negative, 20%, all happening, during the same year. So high growth rate means it's a fast growing stock, fast growth stock. Doesn't necessarily mean it's a uh, safe, riskless. Uh, Obviously, riskless uh, asset doesn't have wide variance. I mean, bonds, AAA bonds, the variance, their, returns variance is very small. So if this is so risky, they would demand, they would always demand much uh, higher required return. Makes sense? All righty. So this is not likely to, not likely. Unlikely to happen. Now, so, but then, that's basically what it is saying. Um, Risky stocks would have, or then, price earnings ratio would go down if that's the case, right? On the other hand, mature firms can also have, yeah, but also mature firms can also have lower price earnings ratio because since low growth rate, mature firms have low growth rates, right? And as growth rate goes down, lower growth rate, of course, then required return would also go down, but required return will always be required return will always be greater than G. Otherwise, otherwise it's gonna be a negative situation, right? The whole fraction will be negative. But anyway, so just because price earnings ratio is low, it doesn't necessarily mean it's. I mean, it could be risky. It could be risky company, but also it could be mature company. It, so you cannot base it on price earnings ratio only. Now, the opposite case is also true. Small and risky startups have very high price earnings ratio. Yeah, risky firms usually have very high price earnings ratio. Risky, small risky startups. Okay, what does that mean? It's all because why? Because uh, startups don't pay out dividends, and earnings may be very startups all if they have good earnings, right? They don't pay out dividends in the first place because they have to reinvest it for growth, and because of the its growth potential uh, for its earnings per share, price is very high. It's mainly because of high price and relatively low earnings. Okay, and Tesla was exactly the case. Tesla was exactly this case, even I'm sorry, even in like 2000, prior to 2012, or Tesla, 2012 was it? I mean, Tesla hasn't been around that long, but I remember in 2000, uh, around 2012, 2013, the first model they put out was, I believe, they went public in 2012, I believe, but they weren't even making any profit even until like 2016, right? In other words, making no profit means no earnings, right? Um, but because of uh, growth potential, right? Uh, because of PVGO, right? Um, Tesla's, even back in like 2000, like 12, 2000, around that time, and I was kind of surprised by their price earnings ratio, because their price earnings ratio was like 100 or something, like Tesla's was like somewhere between 100 and 200. Okay, and they were like back in like 2010, 2012, they were like small risky startup, right? Um, and then I'm just speaking off the top of my head, I mean, from my memory, own experience. I mean, I have to look up Tesla's data, but in 2012, I remember, so let me just quickly look up Tesla, and history. It's history. Let's go to, and it's been around, at least. Let me see. I'm okay. Let me share this with you. Let me share my screen with you. I got to share a screen. Okay, stop sharing. I have to go to share application screen. I hope you should be able to see this too, because I cannot verify if my that's my, yeah. And then let's see. I'm looking at Tesla. I'm hoping that this is Tesla. Uh, Starting from you know 2011, 2010. Tesla has been around for at least 10 years. And then around 2012, look at their, currently, after split, they have, still around they regained, for almost 450, right? As of last trading, it was 442. That was September 18th, 4 p.m. But there was a time they were like, this was like what, about $40, 20 something. I mean, of course, everything is, adjusted, to post split price. They had a split, here, the first split they had. But even in these days, their P ratio was like 200. That was crazy, right? So let me stop and go back to sharing the PowerPoint again. So that was a pretty good example of, it does not contradict. Now, then you might wonder, didn't didn't I say a while ago the risky firms have low price earnings ratio? Uh, I did, yes, but that doesn't contradict. I mean, just because risky firms also have high price earnings ratio, doesn't contradict claim that P price earnings ratio goes down with risk. Just like low price earnings ratio for um, mature firms, right? And so both can happen. And mature firms, think about it, especially mature firms, the reason uh, for mature firms, more, down to earth explanation is mature firms pay good earnings. Most mature firms pay good dividends. They have uh, mature firms are called what's called cash cow. They are mature. That means they have huge market share. Huge market share means what? Uh, they have cash coming and they have huge revenue, right? And of course, being mature means you are in a relatively uh, taking up significant market share. Significant, that means like Coca-Cola and Pepsi, right? They are two giants in the industry. Oh, it's almost duopoly. No other company in the only other one is Nestle. Um, Poland Spring is Nestle. Um, Aquafina is Pepsi. Dasani, Coke, right? Um, they are industry giants. Mature firms are industry giants, right? And you cannot become a mature firm while still being very small, because if your market share is small, and if you're small, uh, some big guys will always take over, right? Why do they take you over? Why do they take over the small guy? Getting rid of competition. Getting rid of competition. Either they can kill you by driving you out of the market or absorb you. But either way, it's getting rid of a competition, right? Potential competition. I mean, if you're very, 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 very small, insignificant, not even 1% of the market, um, they wouldn't even bother because you're not a threat to them. But once you become something like 5% of the market or even 3% of the market, then they will take, big guys will take notice, and they will size you up. They will see if you are going to become a significant threat or not. And if you're likely to become a threat, then if you're, showing, fast growth, and they will try to uh, drive you out of the market, right? Knock off the uh, small guy now, but this small guy is, growing now, and this small guy may not be a threat immediately, but when this small guy grows, then uh, the small guy can topple you, you know, and you're the champion now. And if you're the champion, uh, you will. It's easier to get rid of you. I mean, get rid of this small guy while he's still uh, a kid, right? That sounds very um, brutal and cruel, but that's the nature of the competition, right? Now, um, the evidence of markets increasing expected growth rate. If the market expects, high growth rate, the growth rate will really go up, and then it will lower because the gap, the difference between required return and growth rate will narrow, and then it pushes up the price earnings ratio, right? So again, here insurer firms, uh, no matter how high the price is, right? Uh, they are paying out. Their earnings are good, right? Their EPS. I wouldn't write EPS. Their earnings is good, so as this goes up, the whole fraction goes down, right? Makes sense. That's the idea. So why high risk firms have low? That was explained here. Ceteris paribus, here, B is the same. I mean, everything else is held the same. B being held, of course, ROE being held the same, right? ROE the same, right? Uh, plowback ratio being the same. But the fact that this is constant means these factors are constant, right? Makes sense. If growth rate is constant, steady, not constant, that means ROE and plowback ratio are also steady, and then it's ceteris paribus. Given a constant growth projection, that means P price ratio, price earnings ratio will go down when risk is perceived to be high. Okay. Now, so this is another way of it's just a breakdown of that, and I trying to link it to a DuPont chart, DuPont model. If you took finance 230, corporate finance with me, you should remember what DuPont analysis is. It's just breakdown of all these ratios. I'm trying to link it with here DuPont chart. That's all. But it's not that. It's not that critical to talk about it at this point because it will take time. So we're gonna skip that, and we're gonna be growth opportunities. And to talk about this, Okay, let's talk about this. In the dot-com boom of the late 1990s, companies yet to turn a profit were valued at billions of dollars, right? And why? Why is it exclusively because of the growth opportunities? For example, eBay's 1998 profit was 2.4 million, which was far less than Sotheby's, the Sotheby auction site and auction uh, also real estate. Sotheby's profit 45 million. Yet eBay's market value was 10 times greater, more than 10 times greater, 22 billion versus Sotheby was only 1.9 billion. 2010, and then its 2010 net income, eBay's net income was 1.8 billion, which is 11 times more than that of Sotheby's. Now, Sotheby's. Valuation is primarily by growth opportunities. It's very sensitive to reassessment of such prospects. Yes, this is I've been telling you over and over, growth potential or growth opportunities are nothing but bubble if, right, if things don't materialize. It's nothing but bubble. So, uh, speculative bubble, if it doesn't materialize. Um, and for that matter, uh, Tesla, uh, I'm telling you, Tesla is still a lot of speculative bubble. Uh, now, so when there was a reassessment, when the market became skeptical of the business prospects of the most internet retailers at the close of the 1990s, i.e., the dot-com bubble, right? 1990s, there was dot-com bubble, and then it bursted, right? 1999, 2000. So the revised estimate of growth opportunities, the market revised the estimates of growth opportunities downward. So all stock prices plummeted. That's called dot-com, burst of dot-com bubble. Growth prospects are intrinsically difficult to tie down. Yes, it's true. That's why, remember, there is a hierarchy of uh, we talked about this earlier, hierarchy of valuation. Um, they always, most concrete one is the uh, something like plant and equipment, real estate, but it's like real estate, uh, and the growth opportunity is the most uh, fleeting component, right? Uh, so here we have, we can ask now two questions, but we have already answered those questions. First, what is a reasonable projection of the growth rate of profits? We know how to find, growth rate. Reasonable projection of growth rate is, of course, projection means, forecast that. Right. Now, you should be able to answer that. What is it? ROE times plowback ratio. But of course, because this is a forecast, right? Projection, we should use forecast of ROE expected, but pretty much these ratios do not uh, change that. Of course, it changes, but it doesn't change that frequently, right? So whether you call this expected ROE or not, it doesn't really matter. Did I? So you can just call it ROE, right? Without expectations operator. times times plowback ratio. Okay, so ROA times plowback ratio. So yes, how you forecast growth rate. Then, what is the what multiple of earnings? What multiple that means price earnings multiple of earnings is appropriate to translate an earnings forecast into a price forecast? We already know. You should be able to answer that, right? It is 1 minus b, 1 minus b over k minus g. Okay, and to forecast the price, of course, then, expected price at time t plus 1, right? I'm not going to put the time subscript because when it is forecast, it's already obvious, right? Then what do you need to do? Earnings per share, right? Times, that's, I should also do expected EPS, earnings per share at time t plus 1, right? Next period, times 1 minus plowback ratio over k minus g. Okay, so that answers these two questions. All right, so yeah, time is up. I guess it's been like 40-minute video. So let me. It gets too big. The file size gets too big. So let me stop the video, and I will see you guys next video.